Good morning, everyone, and welcome to the Carnegie Endowment for International Peace. My name is Doug Paul. I'm Vice President for Studies here, and I supervise Asian-related things. We're really pleased you were able to come here under the circumstances. We started a little late, so people who are moving slowly to avoid sweating too much could get here at a comfortable pace. It's really a bad day in that sense. But we're very lucky in that we have Michael Pettis with us. You have his biography in front of you. I won't read that to you. Just point out that Michael has become so important in the world of opinion of China's economy that the PRC announced its adjustment in its valuation of the renminbi on the eve of his arrival in the U.S.
Give me something to do.
And so that people could put it in proper perspective well before the G20 meeting this coming weekend. Michael, I think you wouldn't be here if you didn't already know. Thank you. You wouldn't be here if you didn't already know he's a person of prolific production. He has blogs and columns across the printed and media world on where China is going, where it should go, problems ahead, and misunderstandings that need clarification. So I won't spend a lot of time to pass over to him the opportunity to talk to you today on China. Many views have been expressed. In fact, the New York Times this morning has an editorial on how China's renminbi reform is inadequate. There were hearings yesterday on the Hill. There will be continued discussion as we go forward. I think Michael will bring a particularly valuable perspective this morning. I look forward to his remarks, and we'll then turn it over to questions and answers. One final housekeeping note: if you have a cell phone or a BlackBerry or something, please turn it off. The microphone system in here is very sensitive to the Bluetooth connections especially, so if you could turn your devices off, thank you very much. Now over to Michael.
Doug, how long should I do for the prepared remarks, you think?
As long as you like, but 20 minutes is usually good, 25.
Okay, cool. So the title of the presentation is How Can China Reduce Its Reliance on Net Exports? And if I wanted to be sort of glib, it would be a very short presentation. It really can't. It has a great deal of difficulty in shifting the structure of growth in the economy. The way I think about it, as an aside, I'm planning to write a book this summer, although I've been planning it for 3 years, so who knows. And the working title, the tentative title for the book is China and the Death of the Asian Development Model. Because I think that what the end of this cycle, what I think of as a globalization cycle, means that there has become a significant change in one of the key components of the success of the Asian development model, and that is the willingness and the ability of the U.S. to continue leveraging up so that consumption growth can outpace production growth in the U.S., and that is a rising trade deficit. I think those days are over. And the rising trade deficit is very, very important for large countries that follow the so-called Asian development model. And let me explain why I think that's the case. The Asian development model, which is the model that Japan sort of stumbled on in the 1950s, 1960s, and wasn't invented by Japan. You can trace aspects of it all the way back to Hamilton's 1792 report on the manufacturers. It's a fairly well-developed model, and it has been very successful. Requires a number of things. In order to generate very, very rapid production growth and very rapid employment growth, it's channeled resources into subsidizing investment and production. Now, subsidies have to be paid for, and of course, they always are paid for. And usually they're paid for by the household sector, and this is what exactly has happened in almost every one of these countries that have followed this model. The subsidies are paid for by the household sector. And that has really important consequences and creates a couple of important constraints for the model. Now, what do I mean by the subsidies are paid for by the household sector? There are many ways that this happened, but in each of these countries there were three main ways that you had this transfer of resources from the household sector to manufacturing and to investment. The first and most obvious way is that in all of these countries, and certainly in China, especially in the last 10 years, we've seen that productivity growth has been much higher than wage growth. Why is that important? It's important because what it means is that the total amount of production is not equally shared between workers, who are the household sector, and employers. If productivity growth outpaces wage growth, of course, an increasing share of the wealth is maintained by the employers, and a reduced share of the wealth is maintained by workers, who form the bulk of the household sector. There may be perfectly legitimate reasons for that. In every one of these countries, they all started out from a base of huge rural migration to the city. So the huge army of unemployed farmers moving to the city could have naturally kept wages low. But there were other things that encouraged this. It's been very, very difficult in China to unionize. It's very difficult for workers to have the ability to force wages up, in spite of the recent strikes you've been reading about. The hukou system makes workers incredibly vulnerable, so it's been quite difficult for them to force wages up. So through this differential growth between productivity and wages, you had a huge transfer from workers to employers. The second mechanism that every one of these countries followed, and that is the mechanism that is most widely discussed, is the undervaluation of the currency. An undervalued currency is also a form of transfer. In this case, it's a transfer from net importers to net exporters, or to those who are long renminbi and short against dollars. How does that work? Well, an undervalued exchange rate raises the costs of imports, so it reduces the real value of income. The benefits of that, of course, go to manufacturers in the tradable goods sector, who are able to produce more cheaply because of the undervalued currency and sell abroad. The third mechanism, which is the least discussed, but in my opinion, probably by far the most powerful mechanism, is what economists call financial repression. In every one of these countries, financing was completely dominated by the banking system. In the case of China, more than 90%. Before the crisis, it was 93%, and since the crisis, it's gone up. But significantly more than 90% of all corporate financing takes place in the form of bank loans, not in the form of bond issues or stock issues. On the flip side of it, the vast bulk of Chinese savings are in the form of household deposits, deposits in the banking system. The lending rate and the deposit rate are not set by the needs of the economy or set by the market. They're set by the PBOC, and they're set for policy reasons, and they're set extremely low. How low? Well, the standard model would have told us that interest rates in China, the lending rate in China in the past decade was on average about 8% too low, 8 percentage points too low. More generous estimates of what the correct rate would have been come to at least 400 basis points, 4% too low. So the lending rate has been very, very low. And the deposit rate even lower, and I will get into that in a minute. If you look at the real lending rate and you deflate it against, say, CPI, Consumer Price Index inflation, in the last 5 years, the lending rate has been negative in real terms almost as often as it has been positive. And in very volatile developing countries, the real lending rate tends to be extremely high. In China, it's been very low and even negative. If you deflate the lending rate against PPI, the Producer Price Index inflation, it's almost always been negative. So the lending rate, however you look at it, has been extremely low. One of the paradoxes of Chinese growth turns out not to be a paradox at all. If you ask most people, what is China's comparative advantage in the global market, they will tell you very cheap, disciplined labor. Not true at all. If that were the case, Chinese growth would be heavily labor intensive, and Chinese growth, of course, is anything but labor intensive. It is extremely capital intensive, more capital intensive than any other developing country, including much, much richer developing countries, and more capital intensive than most developed countries. That's explained by the fact that, yes, labor is cheap, but capital is almost free. So from that point of view, it makes a lot of sense for businesses to employ huge amounts of capital in their growth. But this is very important because what it does is it transfers money from net savers to net users of capital. And we know who those are in China. The net savers are the household sector. The net users are governments, corporates, SOEs, real estate developers, etc. And the amount of this transfer is, in my opinion, staggering. I did a back-of-the-envelope calculation recently, and I came up with a number that is so high that I use the lower end of it. The number that I came up with is every single year, between 5 to 10% of China's GDP has been transferred from the household sector to net users of capital. Now, one of the consequences of this, and the consequence of all of these things, is that by subsidizing growth, by subsidizing manufacturing, by subsidizing infrastructure investment and everything else, you get very, very rapid growth. But the household sector doesn't participate fully in that rapid growth. In other words, household income in China has grown much more slowly than national income, GDP. Now, that's not necessarily a bad strategy, because if you look at the last 10 years, household income in China has grown by 8 or 9% a year. Most of us, most other countries would kill for that sort of household income growth, and China achieved it. But it achieved it with GDP growth of 10 or 11% a year. So the net result was that household income as a share of GDP has declined very, very steadily over the past 10 years, especially over the past 10 years, but over a longer period too. Now, why does that matter? Why should we care? If China is able to achieve such rapid household income growth, who cares how they achieve it? Even if GDP grows faster, why is that a bad thing? It's a bad thing because while the development policy can be very, very successful, it runs into two constraints. One constraint everybody runs into, and the other one is a big country constraint. The first constraint that everybody runs into is that when you lower the cost of capital, in a financially repressed system, the cost of capital is way too low and credit expansion is very, very high. If you start from a very low base, if you start from very poor infrastructure, great poverty, etc., all of this investment, no matter how badly conceived it is likely to have positive economic value. So although the Chinese banking system has always been very bad at allocating capital, the capital needs of China were so great that even bad allocation worked. We saw a massive increase in productivity, a massive increase in useful infrastructure, in production, productive capability, et cetera, et cetera. The problem is that you don't have infinite room for expansion. What ends up happening is that as you throw money into investment, the value of that investment can be very steep in the beginning, but it quickly tapers off. When does it taper off? There's no real way of identifying the point in time in which the returns on capital are negative if correctly valued. But I believe, I guess, and I think there is strong circumstantial evidence that that may have happened several years ago. And I can explain why I think that at some other point. So one constraint about this model is that if you start from a very low base, like Japan did, like China did, like Indonesia, Malaysia, Thailand, Singapore, everybody else, you get very, very rapid, good growth in the economy. But you start tapering out. You reach a point, Japan did in the 1980s, China, I would suggest, did so early in the last decade. You reach a point where the return, the economic return on the capital employed is less than the economic cost of the capital employed. But you can hide the fact because interest rates are so low. So in other words, if you give me capital at a 0% interest rate, I can always make money, even if I invest it very, very badly. And I believe that we've reached that point in China before the crisis. Since the crisis, we've clearly passed that point. The second really big constraint is really what I wanted to talk about today. And that is that as production grows faster than consumption, you have excess capacity that you're producing domestically, and you've got to do something with that. So what do? You export it. So all of the countries that followed this model, all of the countries with undervalued currencies, very, very low interest rates, and lagging wage growth, ran large and rising trade surpluses. Here's where it becomes a big country problem. If you're Vietnam and you put into place policies that double your trade surplus, big deal. It's a rounding error for the U.S. But once you reach a point where your trade surpluses become very, very large, then you're heavily dependent on the ability of the rest of the world to absorb those trade surpluses. So how big are these trade surpluses? Have we reached that point? Well, I'd like to point out some historical data which suggests how shockingly large these trade surpluses have been. In the last 100 years, perhaps in history, England in the 19th century complicates it a bit because we're not sure what is England and what is the colonies and how to identify them. But if you exclude the transfers within England and the English colonies in the 19th century, these were probably the largest in history. The three largest trade surpluses as a share of global GDP were number 3 in the late 1920s. The United States ran a trade surplus equal to 0.4% of global GDP. As long as the U.S. was financing the European countries who were running the corresponding trade deficits, we could continue with that big imbalance. But after 1929, 1930, when the bond markets collapsed after the stock market crash, Europe was no longer able to finance it. And so they were no longer able to run those current account deficits, and the U.S. current account surplus became a big problem for the U.S. We foolishly tried to fob the problem off onto the rest of the world with Smoot-Hawley, which would have worked fine as long as nobody noticed. But of course, everybody noticed, and it became a huge problem domestically because we had to reconcile that excess production domestically. Consumption's here, production's here. You can, in theory, bring consumption up, which is what everybody hopes for, but never happens. It's very difficult. Or you bring production down. And as you're bringing production down, you're firing workers. And as you're firing workers, consumption's going down. So you're chasing a moving target. So the U.S. trade surplus was 0.4%. And the U.S., by the way, was over 30% of the world back then. The second biggest trade surplus, you won't be surprised to hear, was in the 1980s. In the late 1980s, Japan achieved a trade surplus that was equal to 0.5% of global GDP. Japan at the time was around 15% of the world. Similar problem. After the 1987 stock market crash, U.S. wealth started going down, and the wealth effect kicked in, and we started seeing a reduction in U.S. overconsumption. The U.S. trade deficit, which was 3.5% in 1987, went all the way down to, I think in 92, we ran a small current account surplus, so it came down quite dramatically. That spelled the end of Japan's ability to grow through rising trade exports. Now, had you been smart, you would have shorted Japan in 1987, and of course you would have gotten killed, right? Because Japan responded, and we've seen this movie before, they responded to the crisis by taking what was already the highest investment rate among any rich country and increasing it by 10 full percentage points of GDP. Now, when you increase investment, you always get growth, right? But the question is it sustainable investment? Is it economically viable investment? In retrospect, it pretty clearly was not. Nonetheless, Japan had the two best years of the Japanese party, 88 and 89. And those of us who are a little bit older will remember that had anyone been foolish enough to stand up in 88 or 89 and suggest that Japan wouldn't be the largest economy in the world by the year 2000, he would have probably been laughed out of the room. At the time, Japan was growing very rapidly, but it was very unhealthy growth. It was based on a massive increase in non-economically viable investment, and the inevitable results of financial repression. Robert Alibur at University of Chicago wrote about this as long ago as the 1960s. The inevitable results were that you ended up seeing a significant increase in debt, first in the banking system, and then you have two options. You let the banking system collapse, which nobody does, or the debt becomes government debt, which is what happened in Japan. So the U.S. was 0.4% of GDP, global GDP, 30%, a little bit more than 30% of the world. Japan was 0.5% of global GDP, about 15% of the world. In 2007, China was between 6 and 0.7% of global GDP. So this is the highest trade surplus we've ever seen as a share of global GDP. It blew out the U.S. and the Japanese trade surpluses. And this on an economy which is about 8% of the world. So a much bigger surplus on a much smaller economy. Now, it didn't matter for a while. As long as the U.S. was growing quickly, and more importantly, U.S. consumer financing, overall U.S. leverage was growing quickly, that meant U.S. consumption was growing faster than U.S. GDP. And it allowed China to have the opposite side, where Chinese GDP was growing faster than Chinese consumption. Everything must balance. But I would argue that the 2007-2008 crisis has spelled the end of the ability of the U.S. to run large and rising trade deficits, that we are going through a deleveraging process. And if we go through this deleveraging process, that means that in the U.S., consumption growth is going to be less than GDP growth, which means the rest of the world has to flip. But who's the rest of the world? Europe? In a minute, I'm going to tell you that Europe is going to make things much, much worse. Japan is in no position to do it. And ultimately, it's going to come back to China, which means that for the next several years, in China, rather than consumption growth being the lower limit of GDP growth, it's going to be the upper limit of GDP growth, which is why we're all so eager for China to boost household consumption. And I'm here to tell you that I don't think there's any way they can boost household consumption for reasons that have to do with the development model. Okay, so China needs this large and growing trade surplus, and it needs the U.S. to run a large and growing trade deficit, and it's not clear that the U.S. can do that. So what happens next? Well, 3 months ago, I would have told you, in fact, I think I did say it when I was here 3 or 4 months ago, that we were going to go through a very difficult adjustment process, that the pace of the U.S. adjustment would determine the pace of the Chinese adjustment. That is, as the U.S. brought the trade deficit down, China would be forced to bring its trade surplus down. Now, can China do it? Yes, it can, but it's very difficult. How is it going to do it? Well, there is a myth that the Chinese don't like to consume. There is another claim, which I also believe is a myth, that the Chinese save because of a lack of a social safety net. I think both of those answers are wrong. That's not why the Chinese don't consume. Chinese consumption has grown very quickly. In the past decade, it's grown by around 8 or 9% a year. You've heard that number before. That was the pace at which household income grew. So, not surprisingly, Chinese consumption has grown as quickly as Chinese household income, and that makes a lot of sense. The argument that the Chinese have increased their savings because of a lack of a social safety net doesn't fit any of the data anywhere else. First of all, the social safety net in the last decade probably improved, yet Chinese household savings went up. Secondly, the real increase in Chinese savings wasn't household savings, it was corporate savings, and to a lesser extent, government savings. Household savings went up a little bit. It's hard to argue that corporates or governments save because of a lack of a social safety net. Most importantly is there's no evidence anywhere around the world that people save more when they have a weaker social safety net. If you look at the Asian development model countries, all of them had very high savings rates. Some, Japan, Korea, Singapore, had great social safety nets. Some had terrible social safety nets. You look at Europe versus the US, Europe, much better social safety net, much higher savings rate. So I think that's not the answer. I think the answer is staring at us right in the face. Chinese save because production has grown much faster than consumption. That, by the way, is simply an accounting identity. Production is equal to consumption plus savings. If production grows faster than consumption, the savings rate has to go up. And the reason production grew faster than consumption is because consumption, the constraint on consumption is household income. And household income has been used to subsidize production growth. So production grew much faster than household income. So if you want the Chinese to save less, consume more, and bring down their trade surplus, you have to reverse all of those transfers. That means you must get the currency to go up, but you can't do it quickly. Because if you do it quickly, the whole manufacturing sector goes bankrupt. How long? I don't know, maybe 10 years. You must get wages to go up, but it's the same thing. You can't do it quickly. If you do it quickly, employers are no longer competitive. And you must let interest rates go up. How much? Probably at least 5 or 6% in relative terms. How much can they support? The think tank associated with the Hong Kong Monetary Authority did a study. And what they found is that the SOEs in China borrow at a lower cost than large corporations, adjusted for size and leverage. And that lower borrowing cost was about 1%. And it makes sense because they're implicitly guaranteed, unlike other large manufacturers in China. And they asked, what's the value in profit terms of that 100 basis points, that 1%? And what they found is pretty astonishing. What they found is that 100% of the aggregate profitability of the SOE sector is explained just by that 1% lower interest rate, right? So if you eliminate the guarantee, the SOE sector makes no money at all. And if you let interest rates go up to a reasonable level, they go bankrupt, right? One of the myths is that Chinese manufacturers are very efficient. No, they're very subsidized. They cannot withstand a rise in the currency rate, a rapid rise in the currency rate, or a rapid rise in interest rates without taking huge losses, which technically means that they're probably value destroyers being subsidized by household income. So you've got to raise interest rates, but if you raise them by 1%, SOEs stop making money, and if you raise them by 2%, probably everybody else, all large manufacturers, stop making money. So you've got to do it slowly. How slowly? There's no real methodology that explains the speed. Conceptually, the way you can think about it is that as wages go up, as the currency goes up, and as interest rates go up, China becomes less competitive in the international markets, so it exports less. On the other hand, households become richer, so they consume more. And ideally, you'd want a one-for-one switch. That's easy to say, it's very hard to do. But there is no historic precedent for that happening quickly. It's taken, in most cases, 10 to 20 years. And China is more unbalanced than most of the cases that I've looked at. So you figure it's got to take at least 10 years for China, with real effort, to make the switch. So the question is, does it have 10 years? Well, 3 months ago, I would have told you probably has 3 or 4 years. Why? Because the pace of the Chinese adjustment will be set by the pace of the US adjustment, and the US tends to adjust brutally but fairly quickly. We saw after 1987, the US trade deficit in response to the 1987 stock market crash came down very quickly. Within 4 years, it went into a small surplus. So I'm assuming maybe it'll take 4 years for the US trade deficit to adjust. So that puts huge pressure on China, and I'm not sure how they withstand it. I know how they've withstood it so far. They did what the Japanese did, but to a much bigger extent, a massive increase in investment. And by now, we're all pretty certain, with a few exceptions, Nick Lardy, a man I have a huge admiration for, in today's newspaper argues that the investment is not wasted. We won't really know for a few more years, but I suspect, and I believe a lot of people suspect, that it is wasted. But that was 3 months ago, I would have told you that. Something new has entered the equation, and it's, I think it is not an exaggeration to call it a trade shock, a massive trade shock, which we're only starting to recognize how serious it's going to be. And that, of course, is Europe. Now, we don't really think of Europe as an important player in the global balance of payments because Europe runs a small current account surplus. And of course, if you run a small current account surplus, you are running an equal capital account deficit. In other words, Europe exports a small amount of money, and it has a small trade surplus in the aggregate. But there isn't a Europe. There's really two Europes. There is Europe of the trade surpluses, which is mostly Germany. Germany has a trade surplus that is a little bit more than half of China's. It's the second biggest in the world. And then a few other smaller countries with trade surpluses. And then there's trade deficit Europe. Who's trade deficit Europe? Well, you've been reading about them. Greece, Spain, Portugal, Italy, France, a couple of others. Trade deficit Europe is big. The trade deficits of trade deficit Europe are equal to about 2/3 the US trade deficit. So why do we care? It balances within Europe. How does that affect China? How does that affect anybody else? Unfortunately, it affects it dramatically because, as you know, you cannot run a current account deficit, most of which is a trade deficit, unless you're running a capital account surplus, right? Every country that runs a current account deficit is a net importer of capital. It's an accounting identity. It's not a theory, it's a requirement. The US imports capital, and I know that because it has a current account deficit. Spain, Italy, Greece, all of these countries until recently were net importers of capital and ran current account deficits. It's the same thing. So can they continue being net importers of capital? Almost certainly not. Greece, Spain, Portugal, God forbid, Italy, are having real trouble simply refinancing their existing obligations. If all they do is refinance their existing obligations, that's another way of saying that their capital account surplus becomes zero. In other words, they receive just as much money, just enough money to repay the money. There is no new capital entering into those countries. That means that their current account deficits will disappear. We saw that in Latin America in the 1980s. In the 1970s, Latin America received capital inflows and ran a large current account deficit. The 81-82 crisis meant that there was no new financing into Latin America. The current account deficits fell to zero. They have to. There's no choice. In fact, Latin America then started seeing flight capital. They started exporting capital. Latin America started running large current account surpluses. There's no choice. You have to do that. So what's going to happen to Southern Europe, to deficit Europe? If they can't finance themselves, their current account deficits are going to go to zero. If they see flight capital, their current account deficits are going to become current account surpluses. There's no choice. And what does that mean for the rest of the world? It means that a current account deficit equal to 2/3 of the US current account deficit is going to disappear. Now, ideally, if it disappears, something else must happen because trade must balance. So if it disappears, ideally, the German trade surplus would disappear. And it would simply balance out, and there would be more inter-European trade, and the overall balance wouldn't matter to the rest of the world. But that's not going to happen, right? The Germans are doing nothing to increase domestic demand. In fact, the big criticism of them now, and for those of you interested in a political career in Europe, German bashing is going to be very popular over the next 4 to 5 years, partly with reason, in fairness. But the point is that Germany is doing nothing to increase its consumption, and the euro has collapsed to the extent that many people are predicting that the German trade surplus will actually rise. So let's assume it doesn't rise. The European trade deficits collapse. That means that that small European trade surplus is going to become a large European trade surplus, and the difference will be equivalent to the contraction in the European trade deficits, right? Just math. The OECD recently estimated that the trade surpluses would go up by $300 billion in the next couple of years. The US trade deficit is roughly $380 billion, I think. So it's a big number. But trade must balance. So something must happen somewhere outside of Europe. What can happen? Well, China's response to the collapse in Europe, domestically in China, seems very plausible. Even outside of China, it seems very plausible. And I'm going to say that no, there's a hidden statement there that as soon as you make it explicit, makes it very implausible. But the Chinese argument is, look, the renminbi on trade-weighted terms has gone up by 15% this year. Don't say we haven't appreciated. We've appreciated a lot. And our most important customer, Europe, is in serious trouble. So we need to protect ourselves. That's why we can't allow the currency to appreciate any further. We've already appreciated it. But that appreciation was not part of the global rebalancing. That appreciation was a response to a massive increase in global imbalances. So basically, the Chinese appreciation was not an absorbing of imbalances. It was a partial reaction to an exacerbation of imbalances. By saying that we need to slow down our appreciation and keep interest rates low and do whatever we can to protect the contraction in our trade surplus, they are implicitly saying that somebody else must bear the burden of the European trade adjustment. Who's somebody else? There's really only one country, and that's the US. So basically what Europe and China, and I would argue, although I haven't brought them into the conversation yet, Japan, are all saying, without saying it explicitly, is that the US trade deficit must rise significantly in order to absorb the employment problems in these various countries. Now that's fine, except that the US has its own unemployment problem, and I would argue that the US appetite for that is very, very low. So my prediction is that the US trade deficit is going to surge this year. It's going to surge because there is no choice. If the European trade surplus surges, something has to happen. And if China and Japan don't allow it to happen in China and Japan, it will happen in the next most obvious place, which is the US. I would then argue that that surge will be accompanied probably by rising unemployment, because it is now cheaper to buy goods produced in Europe than goods produced in the US. It's something like 20% cheaper. So we're going to see a shift in employment there. And it's going to be unacceptable in the US, and we're going to see trade tensions increase significantly. I spoke to, well, I shouldn't identify him. Let's just say someone in the U.S. government after the SED meeting, and I gave him my scenario, and I said, I think by early next year, trade tensions are going to become unbearable. And his response was, I agree with everything you say except one thing. It's not going to wait till next year. I think he may be right, because we've got the elections in November. But I would argue that that's what we have to worry about now. It's not just that China's adjustment was going to be very, very difficult. It's that the addition of the European trade shock is going to make things much more difficult for both China and the US. And unfortunately, it's going to result in a real deterioration in trade relationships between the two. So with that rather alarmist presentation, maybe I can open up to questions or comments or suggestions.
Thank you very much, Michael, for a very stimulating presentation. I'm sure we're going to have a lot of interest in this audience. May I ask you, please, when we identify you to ask a question, please say who you are, where you're from. In the back of the orange shirt.
Judd Harriet, documentary filmmaker. When you said that Chinese exports were very capital intensive, it kind of raised my interest. Could you speak briefly to the role of multinational corporations in the complex of Chinese exports, their participation, their role, what they're producing, and how these other things that you mentioned affect them?
Not a whole lot. I'm much more focused on the monetary aggregates and the balance of payment aggregates. I know that a significant portion of Chinese exports are multinationals based in China. That doesn't really affect any of the arguments. I think the obvious thing that I could say is that if we were to see a significant contraction in China's ability to export and significant trade tensions, to the extent that multinationals have significant operations in China and they're not hedged by operations elsewhere, they're going to suffer in terms of profits. On the flip side, to the extent that they don't have operations in China but have operations in the US or elsewhere, they will probably, I'm not comfortable saying it, I want to say rising profits, but I don't think it's going to be rising profits, relatively rising profits, but I think that the next 3 or 4 years are going to be very bad for consumption and very bad for profits anyway. The world is facing a real consumption problem, not a savings problem, right? Everybody wants to export savings. China exports huge amounts of savings. Japan exports huge amounts of savings. Europe exports a small amount and is now going to export a huge amount, and there's nobody there to absorb the savings. What we really need is consumption, and I just don't see it coming from anywhere.
Question in the second row over here. Carl Dahlman's coming.
Carl Dahlman, Georgetown University. Thank you, Michael. I think it's an excellent analysis, and I agree 100% with what you're saying. But I want to push a little bit is saying, given that this is what's in the cards, what things do you think can be done, both on the Chinese side, on the European side, and the American side, to avoid this becoming a real trade problem and a big rupture? And understanding, and you know China very well, the constraints which they have, because they're worried about employment, stability. Sure. They're facing all this, so it's going to make it very difficult for them to appreciate, which is what we would all like to see, because they're very constrained, and it's also a matter of political stability. So how do you see this thing playing out in the most favorable scenario? And then you can give us unfavorable ones if you wish to.
Well, we have a big consumption problem. And the world is going to slow down. There's no way around it. So I don't think there's a good scenario. There's a relatively good scenario and a relatively bad scenario. The relatively good scenario is that China, Japan, Germany, the US, and deficit Europe get together and discuss, make a grand bargain in which we assign the pain of the adjustment in the most rational way possible. We slow down the adjustments in Europe and in the US, although I think it's almost impossible to slow down the adjustments in Europe unless you can find someone who's willing to lend huge amounts of money to those countries. But we try to slow them down and apportion out the pace of adjustment. But having said that, would I bet on it? No way. I mean, there's simply no way we're going to get together and form a grand bargain like that. The historical precedents are pretty clear. We're entering into a beggar thy neighbor set of policies. And Barry Eichengreen said something really interesting about the 1930s. He said, you know, there were two types of beggar thy neighbor policies. Countries that were able to manipulate their currencies did so. That's the best way to cheat. But he said some countries couldn't, the gold bloc countries and the United States until 1934. So what did they do? They resorted to the next best set of policies, tariffs and import quotas. I think that was a very insightful statement, and I would argue that that's much more likely what we're going to see. We're going to see that countries that can manipulate interest rates and currency will do so. They will keep them low or try to reduce them. They will intervene to lower them. And the countries that can't, like the United States, will almost certainly resort to the only thing they can do, which is tariffs and perhaps import quotas. But I'm not optimistic that there is a good way out of this. Next is
Yes, Richard Cronin with the Stimson Center. Michael, I've been actually following your prodigious writing for a number of years, and as well as some people like Brad Setzer with the Rubini group, and I'm very persuaded of your argument. Now, what I'm interested in right now is that you're focusing on trade conflict, but I'm sort of more interested in what's going to happen in China in terms of China's economy and political stability, for one. And then the other is, how does this fit into the agreement by China or the promise by China to have a more flexible currency? Because some people in China do seem to be persuaded that they need a stronger currency for the longer term. But what you're suggesting is that's not going to happen. So I wonder if you'd comment on both of those. Thank you.
Yeah, let me talk about the currency. Externally, I think a lot of people consider me sort of way on the pessimist side. And externally, there's also a perception that there's a consensus in China. Everybody knows what's going on and everybody agrees. The first thing is true. Among foreigners, I think I am probably on the more pessimistic side, although I don't believe, like Jim Chanos, that we're going to see a banking collapse. But within China, I'm not. Within China, there's a huge debate going on. And I've even had, someone that I admire a great deal. Once, I always tell this story, so some of you may have heard it before, but we were at a conference, and he turned to me and he said, the problem with you, Professor Pettis, is that you're a typical American. You're just too optimistic. And when I read some of the things he says, yes, I'm a little bit more optimistic than he is. There's a real sense within China that the imbalances are unsustainable, but it's not really clear what to do, and there's a split in how it's approached. So you have people at the PBOC, the central bank, at the National Bureau of Statistics, some of the think tanks, some of the universities, that fully agree and have said over and over again, we've got to raise interest rates. In fact, there was an article in Global Times last week, not necessarily a place I go to get great enlightenment, but nonetheless, it's a Chinese magazine, in which the author, who is a professor, I think at People's University, was ferocious on the subject of interest rates. I mean, he said very clearly in the last paragraph, the whole interest rate system in China is nothing but a scam to steal money from poor Chinese households to fund all of the corruption among local, they always say local and municipal governments, they never go higher than that. But, I mean, he said it very clearly, and I wouldn't put it that way, it's a mechanism of transfer. But, so I think there's a big recognition of this, but the domestic constituencies, the SOEs, the provincial and municipal governors, et cetera, don't really get it. And this is not unprecedented. In 1930, a lot of Americans, including President Hoover, by the way, understood that Smoot-Hawley was a terrible mistake, that it did not make sense for a trade surplus country to continue trying to push its excess capacity abroad, that it was very vulnerable, that it needed to rebalance. But at the end, Hoover couldn't veto Smoot-Hawley because had he done so, he would have certainly lost the election, which he lost anyway. But the mining interests, the domestic agricultural interests, domestic manufacturers, they were very clear. Every time we have a problem, we raise tariffs, manufacturing expands, we have a problem, let's raise tariffs. The problem was that it's true, they were right in the past that it always worked. But before World War I, the U.S. was always a trade deficit country. So it worked. After World War I, the U.S. was a leading trade surplus country, so it no longer worked. And I think that's the problem in China. A lot of the domestic guys say, every time we've had a problem, we just boosted investment, and it worked, right? Yes, it worked. They boost investment. A couple of years later, the trade surplus would surge, and then the U.S. trade deficit would surge, and the U.S. would simply absorb that additional capacity. But I would argue that the conditions are different, but they don't get it. So there is a real debate, and there is a real recognition. I think Premier Wen recognizes it. I think he knows the currency's got to go up, and interest rates have got to go up. But it's very difficult to do so without creating a lot of pain in the southern provinces and the Ministry of Commerce and their whole faction. So it's tough to do. It's very difficult to do. But they're going to do it one way or the other. Now, they do have a magic bullet, and that is that if you have to increase household wealth, there's one way to do it. The government owns tons of stuff, land, SOEs, banks, et cetera. It could transfer ownership directly or indirectly to the household sector. And then you could get a surge in consumption, a real surge in consumption. But I think that it will take a crisis before they do that.
Next on the list is Jessica Matthews.
Jessica Matthews, Carnegie Endowment. Michael, when you said that there are these three ways to attack this, appreciating the currency, increasing wages, and increasing interest rates, and that all three of them have to be very slow. But on the other hand, when you've got three, each can absorb some of it. And in particular, I want to ask you to say more about the wage issue, because both with respect to what's happening and your sense of the significance of what's happening with the strikes and the calls for more wages, but also whether there isn't a large room for huge increases in wages in the private manufacturing sector, if not in the SOEs, and with companies that can still be very profitable, even with 100% increase in wages.
Well, it's a very competitive market. And one of the ways that manufacturers in China compete is on the basis of low wages. So I haven't really seen any studies done on as to how much manufacturers can increase wages before they become unprofitable. But I suspect that you can't simply double wages without an awful lot of bankruptcies, or even increase them by 50% without an awful lot of bankruptcies. In fact, I think we should be a little bit careful about what we're reading about wage pressures. There certainly has been significant wage pressure recently in certain areas. In other areas, not so much. College unemployment is soaring. But my fear is that increased wages are not going to drive growth through increasing household income and consumption. I think they're a consequence of the existing growth. And what I worry about is if you slow down this massive credit expansion and this massive investment boom, which Beijing says they want to do, I don't think they'll do it, but they say they want to do it, then I think wage pressures begin to dissipate and wages will start either going down or staying at the current level. We should see what happens after September and October, because a lot of the wage contracts run out around that time. And I suspect that we won't see as much pressure after that as we've seen before. I'm not really sure. But I would have to say that I think the wage growth is not a driver of growth, it's a consequence of growth. And the recent growth has been a very unhealthy growth caused by a massive increase in investment. And what I worry about is that as soon as that investment slows down, because we start saying, look, wages are going up, so consumption can now drive the economy, wages will stop going up, and it will no longer drive the economy. I think wage growth is actually pro-cyclical here. It's interest rates, I think, is the key mechanism.
Next on my list is Yukon Wong from the front.
Yukon Wong, Carnegie.
Page your microphone, please.
I used to also work for the bank for 20 years, and I'm also in China. And I think I agree with a lot of the things you're saying. I agree with a lot of things, have the same alarmist feel about China. For whatever reasons, they always do better than I thought they would. And I've always asked, why is that? Why every time I make a prediction, doomsday or whatever, the outcome indicators always turn out to be more positive than everyone thought. And I will come back to that because I think there's a very important issue here about why is that the case. Let me go back a second on the exchange rate and the trade business. There's not been a full explanation of why during the 2005-2008 period, when China's exchange rate appreciated by 20%, that's precisely the time when China's trade surplus ballooned. So the only times when you have exchange rate appreciation, China's trade surplus has actually increased rather than declined. So when people talk about appreciation leading to a decline of trade surplus, they've got to get over that a second. Now, the second point I would actually like, you cannot understand China's trade surplus and what's going to happen without putting in the context of what's happening in East Asia. China's trade surplus with the West is not a pure China trade surplus. Essentially, most of it is a shift from the rest of East Asia to China. So China's trade surplus shows up as China, but it's not actually. It's East Asia's trade surplus. And that overall trade surplus hasn't changed. It's just now it's in China, the rest of East Asia. Now, I'll come back to that because I actually think that's critical in terms of what the future trend will have to be. Now, let me go back to another issue. I think you're absolutely correct that China is going to have to go through a major adjustment. And all the pressures you indicated show that's going to go in that direction. I think the big question is whether that adjustment will be smooth and easy or manageable, or whether it will be extraordinarily dislocative. And I think you're absolutely correct to show that there's lots of risk factors here. Now, the critical question is, China always felt that it had to grow at 10% a year to generate jobs and to grow or do whatever. And the first question one has to ask is, that's kind of funny. Why do you have to grow at 10% to achieve your goals? Can't you achieve it at 7%? And I think the answer is you can. So I think the real issue for China is, can I achieve at 7 or 8% growth the objectives I had when I was trying to grow at 10 or 12? And the answer lies in your discussion. Yes, I can if I'm more efficient or whatever. If I actually allow consumption to grow, I'll have a better growth. So 7 or 8% is not a doomsday scenario. 7 to 8% is actually a good outcome provided certain things change. Now, let me go back to what is going to change. What is the biggest driver of what will force China to change? It's really inequality. The inequality between the coastal regions and the interior, the inequality between urban and rural areas. The urban-rural income ratios are the highest in the world, so there's a problem. The inequality between the coastal areas and the central regions are extraordinarily high. They've not been declining, so there is a problem. And this is felt in wage pressures and all sorts of issues. Now, how will that play out? And let me just point out two factors that will play out. Despite all the inefficiencies in investment and the subsidies to the state enterprise sector, what is actually extraordinary in China is that the efficiency of enterprises overall have been improving consistently for the last 2 decades. So while there's a subsidy to the enterprise sector and profits may be elevated, the quality of the profits in competition in China is extraordinary. And so I think the thing that saves China is you have a really inefficient system, you invest too much, you do all sorts of protective things, but how did you get an economy which is extraordinarily competitive in being able to shift across product lines so easily and to improve quality so quickly than any other country in the world? And that's what protects China, because despite all these problems, that's why they're so strong. Now, the interesting thing in China is that competitive pressure which leads to efficiency and response is actually still there and increasing. And that's why I'm so positive about China, because I see that as the explanation of why China does so well and better than anyone predicts. Now, what will actually change in China over the next 10 years which will solve the problems? And I would say there's 2 factors. There's going to be a major shift in activities from the coastal areas to the central areas. Exchange rates, cost, wages, boom, boom, boom. Rising consumption services, less orientation to the outside world. Now, the other thing which is going to shift, which I think no one fully understands, is the production sharing network process is going to shift. You're not going to see a splitting up of production across countries as much as in the past. And that explains largely why the trade surplus shows up in China. You're actually going to see vertical integration within countries. And because of rising energy prices, other kinds of costs and barriers are showing up. Also, the product mix is going to show up. So China's growth in the future is going to be a little bit stranger. It's going to actually occur from a shift of production to the interior, more vertical production processes, and I think the other looming factor is a trade with South Asia and India in a way that actually people have not fully recognized, the trade for services. And that's going to lead to actually a change in the production pattern and growth in the trade, which I think has not been fully analyzed. I can't predict what's going to happen. But I think the good outcome is that China's growth remains at 7 or 8%. It's more sustainable. It's more efficient. You're absolutely correct. Some of these subsidies and other things have to be eliminated. Let me just throw that in
That's a longer question than we normally allow in these forums, but
No,
since,
but
I think it really adds to the discussion. Thank you very much, Yukon.
Several comments. First, I agree with you that a lot of what's taken place is that the East Asian trade surplus has shifted to China. And I think there are good reasons for that. And I think, I won't get into a very long discussion of that, but I would point out that we're used to thinking of the most tense trade relationships being U.S. and China. Not true. The most tense relationships, trade relationships, are between China and other East Asian countries, or China and India. In fact, the Minister of Commerce, Chen Deming, about 2 or 3 months ago, said there is a record number of suits against China, 119, and the U.S. is leading the charge with 23 of them. I think India has now surpassed the U.S., but I did the math, and 23 is 19% of 119, and the United States is 25% of the world, more than that of the world ex-China, and much more than that as a share of total imports and as a share of total trade deficits. So I actually see it as the U.S. is lagging the world rather than leading the world in trade disputes. What I worry about is that if we start seeing more anti-Chinese tariffs in the U.S., that's a green light for everybody else. It makes it intellectually more respectable. That's why the U.S. is so important, not because it's leading the charge, I think. But yes, I agree, there has been a huge shift there. And that's why there is so much complaints in a number of countries, India, Indonesia, Korea, et cetera, about Chinese growth. Now, you mentioned that the trade surplus went up from 2005 to 2008 just as the currency went up. It went up by 21%. And I think that's a really important point because I insist over and over again, very unsuccessfully, that it's not the currency. It's the gap between production and consumption. That's what creates the trade surplus. If I produce more than I consume domestically, I must export the balance. So the key issue is what causes that gap. And I think there are a number of things, but I think the three most important are the wage productivity differential, interest rates, and the currency. And the currency is probably the least important of the three. So what happened in 2005, 2008? Yes, the currency went up. But what happened to credit and interest rates? Real interest rates came down very sharply and credit expanded, right? So I would argue that interest rates are more important than the currency in determining the trade surplus. The currency matters, but it's one of many factors that matter. So if the currency goes up but interest rates go down, it's very easy for the trade surplus to expand. In fact, we saw that before because after the Plaza Accords, when the yen went up, so did the Japanese trade surplus and the U.S. trade deficit. By coincidence, Japanese interest rates came down and credit expansion was massive during that period. I would say that's what matters. Anything that affects the gap between production and consumption is a trade matter. The currency is simply one of those things. And then the final thing, you said 7% to 8% growth is good enough, more than good enough. First of all, I don't think we're going to get 7 to 8% growth. There's press here. So my official position, which I wrote about in the Financial Times about 1.5 years ago, was that for the next decade, we should see growth rates of between 5 and 7%, heavily front-loaded. The more we get now, the less we'll get later. I'll just let you know that's my official position, and there are press here. But Arthur Kreber, who's an economist in China, a very smart guy, made a very good point. He said, if you look at other developing countries and you compare the amount of new employment that China is receiving, what kind of growth rate do you need to absorb the new entrance into the labor market? And he claimed, and I don't know how he did the work, but it's plausible to me, that if you could look at other developing countries, 3 to 4% is enough. 3 to 4% is actually pretty good growth rates. The problem is that it means a very, very different growth model. It means much rapid growth among small companies and in the service industries. And I think we would all agree with that. If we could shift growth away from the capital-intensive sector to the labor-intensive and service sector, China could tolerate much lower growth levels and still absorb the rising labor. But that's easy to say. But it means, in my opinion, political reform before it means economic reform. Because basically, the control that local officials have is the control of the banking system, the control of interest rates, and the control of the SOEs. And what we're saying is it's no problem. Just have them give up controlling the banking system and interest rates and the SOEs, and we can do very, very well. And I agree. I just think it's going to be really difficult for us to get that. And the Chinese will do the right thing. They always do, but it takes a crisis. And I think that's what it's going to take.
Thanks. David Lynch with USA Today. Michael, I want to ask you to spin out the consequences of your argument for the global economy. If, as you say, there's going to be sort of this global refusal to accept the impact of the shock from Europe, you're going to have this sort of negative tug of war between the U.S. and China. What does that mean for the global economy? You've alluded a couple times to the 1930s. Do you see that sort of scenario? And second quick question, could I ask you to update your official forecast for the PRC?
I'd rather not do the latter. There's a very famous article by Paul Krugman, The Myth of the Asian Miracle, that came out in Foreign Affairs in 1993. And I was rereading it recently. And Krugman was very bearish about Japan. He didn't really believe in the Japanese miracle. And he turned out to be right, of course. But in the article, he said something that I found really very, very interesting, because although he was a bear about Japan, and although Japan in 93 was doing very poorly, he predicted that Japan would continue to do very badly for at least 4 or 5 more years. Probably they would have difficulty getting growth to be above 2 or 3%. That was Krugman's definition of difficulty for Japan, right? 3, 4, 5 years of growth, 2 to 3%. That's how bad it's going to get for Japan. Well, guess what? It was a decade of 0% growth. I think sometimes it's hard for us sometimes to understand how dramatic the shift can be. So with that, I will just say that the reason I picked 5 to 7% is because for many years, Chinese GDP growth outpaced consumption growth because of the U.S. doing the opposite. If the U.S. reverts, which I think it will, then consumption growth becomes the upper limit. Consumption growth has been 8 to 9%. Let's assume it continues at 8 to 9%. That gives us GDP growth of maybe 6 to 7%, maybe a little bit more. The only thing I would tell you is that if GDP growth goes from 12% to 7%, I think it's really unlikely that consumption growth is stable. And again, Japan's a great example. Consumption growth in Japan was around 5 or 6% in the 80s, and GDP growth was higher. And in the 90s and in the last 2 decades, Japan rebalanced. Rebalance just means consumption growth outpaces GDP growth. But how did it rebalance? Consumption growth slowed to 1.5%, and GDP growth dropped to 0.3%, right? So what I'm afraid of is that something like that happens. I don't predict at all that China is going to have 10 years of 0% growth or even 5 years of 0% growth. I just think that the numbers are going to be lower than anything that we're used to. And globally? I'm just a China scholar. I don't know what happens in the rest of the world. I'm always impressed by the ability of the U.S. to adjust. It adjusts very, very quickly. I don't think we're facing a 1930s scenario, because I think in the 1930s there were some really major mistakes made. I think we're doing minor versions of those mistakes. So when people say Keynes said in the 30s that the U.S. must expand, therefore the U.S. must expand today fiscally, I think there's a little bit of a mistake. Keynes didn't say the U.S. must expand because it was the U.S. He said that the U.S. must expand because it had excessively high savings and was the leading surplus country. It had deficient demand, and it was the U.S. responsibility to resolve that deficient demand. In that case, I would say today you can hardly make that claim about the U.S. The U.S. doesn't have deficient demand. It's the biggest trade deficit ever, right? Except our own trade deficit 3 or 4 years ago. It's the countries with deficient demand that really need to follow those Keynesian expansionary policies. That's why I guess it's going to be very popular to criticize Germany, Japan, and China, because that's really where the deficient demand has to be made up. But I think it's going to happen. I don't think we're going to have negative growth rates for however many years we had in the 30s.
Next question from the young lady in the third row.
Hi, my name is Logan Ashcraft. I'm an international studies student at Johns Hopkins. And I was just wondering, well, I've been reading a lot about efforts from the Department of Commerce to boost exports coming from small businesses within the U.S. And I'm just wondering, if those efforts were to in fact succeed, what impact, if any, could this have on your projections?
Well, I'm an aggregate guy. I look at the aggregate balances, and so for me, the total amount of the U.S. trade surplus is going to be a function of a number of different things. It's going to be a function of the total investment. It's going to be a function of total savings. It's going to be a function of policies abroad. If Europe, Japan, and China are exporting massive amounts of capital, and the U.S. is importing massive amounts of capital, because it's the only place the capital can go, I don't care what the Commerce Ministry does, or the Ministry, Commerce Department does. I'm so Chinese. The U.S. is going to run a large current account deficit. Now, there are different ways you can run a current account deficit. You can run it a good way, because there's this massive investment in infrastructure in the U.S., or you can run it a bad way, because there is a collapse in production. I'm not smart enough to tell you how it's going to happen. I can just tell you, this is just accounting identities. If everybody's exporting capital and the U.S. is importing capital, the U.S. will run a large current account deficit. How they do it, I don't know, but they'll do it.
Thank you. Paul Eckert of Reuters News Agency in Washington, a loyal reader of your blog, among other things. I'm wondering, especially sitting in Beijing, where you most often do, how you assess the Schumer and other Stabenow, that currency bill. Is it a volley-like, Smoot-Hawley-like opening volley of possible trade friction? And two, the relatively newfound U.S. official focus on indigenous innovation, is that also a sensible way to confront China? And in your own view, are there smarter battles to pick with China, if either at a multilateral or bilateral level, if you want to try to address these frictions that are cropping up?
First of all, the U.S. can't pass Smoot-Hawley. Smoot-Hawley, by my definition, can only be passed by a surplus country. Smoot-Hawley in the U.S. context doesn't really make sense. The U.S. is a deficit country. It's a very, very different mechanism. It seems to me that the smartest way for the U.S. to resolve these imbalances, remember, the trade surpluses and trade deficits are caused, in my opinion, and high savings and low savings, in my opinion, are caused by policies. And it's any policy that affects the gap between production and consumption, or more generally between supply and demand for products, affects the trade surplus. So if I could advise the administration with any chance of their A, following the advice, and B, being able to put it through Congress, I would say rather than tariffs, there's a much more powerful way of reducing the U.S. trade deficit, and a much more obvious way, and that is by shifting the demand between consumption and production. How can you do that? Well, let's put a tax on consumption, or on oil. My Washington friends tell me, don't even start, you're going to go nowhere. But yes, if you do that, you are penalizing consumption. And if the proceeds are used, let's say in an ideal world, for improving U.S. infrastructure, you are helping production. And by doing that, you are forcing the U.S. trade deficit down over the future in a very, very healthy way. There are lots of ways of doing it. Tariffs are the most combative and the least efficient ways of shifting the balance. But politically, they're probably the easiest way, right? I mean, it's in the U.S. and China, anywhere, the best defense is to criticize foreigners. But there are better ways of doing it.
Lady in the black and sixth row.
Jing Yuan from the Center for Strategic and International Studies, as well as a PhD student at University of Maryland. And I actually have two questions for you. The first one is, you mentioned that China should raise its interest rate to a more market competitive level, but the problem is that the Chinese government couldn't do it at the cost of crushing its SOEs, and now things the state-owned enterprises are basically heavily subsidized. So there is an argument in China that the Chinese government should first privatize its SOEs and to increase the volume of the lending from the state-owned banks to the small and medium-sized private enterprises. So I'm just wondering, do you have any comment for that? And the second question is, though recently the situation in Europe is really awful, but China increased its investment in Greece recently. So I'm just wondering whether you have any comment on just what is the China's major motivation of doing that? Is it a way to back up the euro, or is there any other motivation? Thank you.
Well, I wrote a blog entry maybe 3, 4, 5 weeks ago. It's the only one that ever got me hate mail. And the title was, "Are you ready for a United States of Germany?" And the basic argument was that the euro is going to, I never believed the euro would survive. And the euro will break unless they reassign fiscal sovereignty. And ideally, they should assign it to Brussels, but of course, Germany will never assign sovereignty to Brussels. So the alternative is that everybody assigns it to Berlin. But of course, everybody hates Germany, so that's not going to happen either. I'm half French, and I can tell you, France is not assigning sovereignty to Berlin. But at the end of it, as a joke, I said, one of the ways that China can deal with the trade shock is by supporting the euro. And that was meant to be a joke, because I didn't think they would do it. And then recently, I heard that they were buying all this Greek stuff. So I'm not really sure. As an attempt to support the euro, the numbers aren't really that big, so it's going to take a lot more than that. Or is it simply an attempt to help in a way that's not so damaging to China? Because the nicest thing they could do would be to buy European or buy Greek government bonds, but I don't think they're that dumb. So they're buying real assets, and hopefully they're buying it at a fire sale price. So I think that helps, and I think it may be a smart move. But I don't know if there's any deep policy reasons behind it beyond that. The first thing that you said about privatizing and pushing credit to the small companies, yes. I think everybody, at least everybody in academia and the think tanks agree, right? But that's like my discussion with you, Con. That I think is political reform more than anything else. It means giving up control of credit, interest rates, and SOEs. And China will eventually do that, but it's just not easy to do. You're basically asking people to give up their biggest source of power.
Just to observe on that point, we are entering a period in China which is largely unnoticed, which is the jockeying for position for the 12th Party Congress. And this jockeying means you have to get your onward assignment stabilized by this October in order to get 2 years in the job, so you can then bid for a higher job later. And so the politics right now are very intense, and the currency of these politics is, just as Michael said, it's access to this capital. A couple more questions before we let Michael get away. Anybody have a... Oh, way in the back, yes. Sorry.
Juan Ramon Zarco of Revenue Spark. I'm curious, Michael, you mentioned that to help the United States versus China, being a student from business school of international comparative analysis, is to allow the U.S. somehow or another to reduce consumption, increase production. But hasn't the United States really relinquished its power and authority and experience of producing items, manufacturing? I mean, we're losing that battle with the rest of the world. So how do you see that playing out, or is there any light in the tunnel where we can produce more than we've been doing last 10 years?
Well, the U.S. is still the largest manufacturer in the world. I think there's expectations that it'll be overtaken by China this year. But I would really hesitate to say that the U.S. has given up manufacturing. I think the last decade has been very, very difficult. But, you know, I hate to ruin my reputation as a pessimist, but I remember in the 1970s, way back, it was pretty clear that the U.S. was dead in the water, right? And everything was wrong. Watergate and Vietnam, and the economy was collapsing, and we weren't producing anything, et cetera, et cetera. The U.S. has an amazing capacity for getting into trouble and then restructuring itself. So I know that's not really a very scientific statement, but I suspect that once we get through restructuring a lot of the debt and cleaning up the banks, which is going to really weigh on consumption, you know, somehow the U.S. manages to be incredibly innovative and figure something out. Again, that's not a very scientific prescription, but I'm less worried about the U.S. than I'm worried, for example, about Europe. Europe, this thing is going to go on for years and years and years. It's going to take us about 7 or 8 years once the banks have sufficient capital to recognize that basically a number of countries are insolvent. We can't recognize it until the banks have enough capital to absorb the losses. That's what happened in Latin America. And those countries won't grow until we recognize that they're insolvent and restructure the debt. So we've probably got 5 or 6 years of everyone pretending. But anyway, that's a sidebar. I don't think the U.S. is as weak in manufacturing as many people believe.
My recollection of the figures is that mid-1960s, the U.S. share of GDP that was in manufacturing was 27%, and last year was 25%. So the perception of a decline in manufacturing is really different from the reality of that situation. Final question?
Hi there. Thank you. Darius Jonker from the South African Embassy. Just your comments on the role that the developing world, and especially your major emerging economies, Brazil, India, and some of the larger African economies can play in providing that consumption you say is needed.
They're too small. In China, you know, there's this big discussion about who will replace the U.S. as the trade deficit country. And one government official told me very excitedly, you know, China runs bilateral trade deficits with a lot of developing countries. All we have to do is eliminate those bilateral deficits. And I tried to make him see the irony of when the U.S. talks about eliminating the bilateral deficit, that's protectionism, but when China talks about eliminating bilateral trade deficits, that's just good sense. But I also tried to work through the numbers, and the numbers are just not there. I mean, if you take everybody in the world except the United States, Europe, Japan, China, you're not left with an awful lot. You're left with an economy that's slightly smaller than the U.S. Okay, fair enough. But there's a big difference. The U.S. can run large trade deficits for many years. The developing world can't. Every time that happens, Latin America in the 1970s, Asia in the 1990s, you reach a point where you run up too high debt levels and you run into a debt crisis. And there's also another problem, is that everybody wants to export their way out of the mess. And that's just obviously logically impossible. A friend of mine went through the IMF country projections. You know, these are supposed to be reasonable projections for growth for whatever, 120 countries. And he said, it's really fun. Add up all the export projections and add up all the import projections, and they don't match, right? In fact, there's a pretty significant difference between them. So remember that the way in a world of contracting demand, the way you contribute to global growth is by providing net demand, and net demand is the trade deficit. So maybe we'll see some consumption growth in developing countries, but nowhere near enough to make up the contraction in the U.S. and Europe. My additional fear is, you know, I'm an emerging market guy. I spent most of my career on Wall Street trading EM debt, and I spent a lot of time looking at the history of emerging market countries. And I am not convinced at all that there has been decoupling. I don't think the BRIC countries and the emerging markets have achieved a growth that's independent of the growth in the developed world. I think what we've seen is that the collapse in the U.S. was very bad for EM. China responded with a massive but unsustainable increase in investment. And that massive but unsustainable increase in investment, plus a lot of commodity stockpiling, bled into the developing world to the extent that much of the developing world is still commodity exporters. But, you know, I go to Brazil pretty often, and by the way, I'm not the only one who says this. A lot of people in Brazil are worried about this. A slowdown in China is going to be very, very bad for commodity exporters, most of whom are in the developing world. So I don't think we can count on them to be an independent source of net demand.
One final question.
Michael, you talked about the U.S. and Europe. What about Japan? Is it stuck permanently?
I've been reading more and more about Japan, unfortunately, to try to get a better clue of what's likely to happen in China. The problem as I see it in Japan, and this is a little bit what happened in China after 2000, because around 2000 we had a banking crisis in China. Something like maybe 40% of all loans were non-performing. And one of the things that the people who are more bullish than I am keep saying is, look, who cares about a banking crisis? China had a banking crisis, and it resolved it, no problem. It had no impact on the economy. So it can do it again. And my interpretation is very, very different. It had a terrible impact on the Chinese economy because basically the banks had to be cleaned up. And who cleans up the banks? It's in every country, not just in China, it's the household sector, either through explicit taxes or hidden taxes. How did the household sector clean up the banks? One way is that interest rates were kept very, very low to slow down the accumulation of non-performing loans. Basically, when you force the interest rate down, you are granting debt forgiveness. And that debt forgiveness is being granted by the lender, who is ultimately the household depositor. So one way was to keep interest rates very low and force debt forgiveness to be covered by the household sector. Also, when the government borrowed money at very low interest rates to give as gifts to the banks, that also came out of the household sector. And then the other thing they did was they kept the spread between the deposit rate and the lending rate very wide, like more than 2 times what's normal. And the PBOC was explicit. Why are we doing that? Because we need to recapitalize the banks. So basically the household sector paid to clean up the banking system in the last 10 years. And they paid a huge price. My calculation is somewhere between 5 to 10% of GDP every year. The consequence, I think, is that in 2000, consumption was 45% of GDP. Very low number, not unprecedented, but very low, right? Malaysia, after the crisis, dipped down to 45 before it went back up to 51. So very bad numbers. In 2005, consumption went down to 40% of GDP, which I think is unprecedented. And Beijing said this is a disaster, we've got to change this, we've got to raise consumption levels, but it kept coming down. Last year it was around 36% of GDP. This is off the map. We don't even have a map that has this number in here. And I think it's not a coincidence. The household sector had to clean up the banking system, and the bill was so high that it constrained consumption growth. What does all this have to do with Japan? I think the same thing happened in Japan. These huge debt levels are only manageable because interest rates are so low. And very low interest rates are implicitly debt forgiveness, paid for by the household sector. And as long as the household sector is cleaning up the banking system or cleaning up or repaying the government debt, and I think this could go on for many more years because government debt levels are so high, you can't ask them to spring into life and start consuming. So to me, my limited reading of Japanese economic history, and I warn you it's limited, is that there was a very strong connection between very high debt levels and the inability of Japanese consumers to bail the economy out. And that's why I worry about China if we have another debt crisis, another banking crisis.
Well, Michael, we've come to the end of the hour and a half, and I want to thank you very much for coming to Washington and visiting your home away from home at Carnegie to introduce some really different insights into what has been the echo chamber of China trade debate here in Washington. That's much appreciated, and thank all of you for joining us this morning on a hot and sticky day. I'm very glad to have you here. Please come back and visit us again soon. Thank you.